Tonight we're going to work through chapter 11, and as you can sort of see from the title, it basically focuses on taxable income. And taxable income is after we calculate net income for tax purposes. So we have to calculate net income for tax purposes first, and then to get from net income to taxable income, that's sort of where we get to use these loss carryovers. Let's sort of quickly review the different types of loss carryovers that we've talked about. The ones that we sort of focused on were the non-capital loss carryovers and also the net capital loss carryovers. So non-capital loss carryovers, you can use those and you can carry those back 3 years. You can carry those forward 20 years, and you can use those against any type of income. The other loss carryover that we've talked about is net capital loss carryovers. And remember, net capital loss carryovers, those originate from 3B if you have more allowable capital losses than you do taxable capital gains. So you do have a net capital loss carryover. You can carry those back 3 years. You can carry those forward indefinitely, but those can only be used to offset taxable capital gains. So those are the two that we sort of looked at in quite a bit of detail over the first 10 chapters. The one that we saw in chapter 8 was about listed personal property. So in chapter 8, we talked about when you sell listed personal property, things such as jewelry, the coin collection, the stamp collection, those gains you have to include, but the losses are also deductible. The losses, if you can't use those up in the particular year, because remember, LPP losses, you can only use against LPP gains. If you have any listed personal property losses that carry over, they can be carried back 3 years, carry forward 7 years, but they can only be used to offset LPP gains, listed personal property gains. And so we talked a little bit about those in chapter 8, and it's sort of brought up again in chapter 11 when they talk about loss carryovers. The one thing that we talked about last week was net capital losses in the year of death. So last week we already went through Appendix B, the handout for Appendix B, which is in chapter 11. We went through that last week, and we said that in the year of a taxpayer's death, they can actually use the net capital losses against any type of income, either in the year of death or the year before death as well. So we did sort of cover that at the end of last week. The one loss that we're going to sort of talk about in a little bit more detail, which is a new one, is farming losses. So if you have a farm and that's sort of your full-time occupation, that's your main source of revenue, any farming losses will just be treated as non-capital loss. So let's just sort of talk about farming losses, and let's just sort of divide it into these 3 categories: a full-time farming, part-time farming, and hobby farming. So if you are doing full-time farming, that's your sort of main source of income. Any farm losses are treated as business losses, and any farm losses unused in the current year become non-capital loss carryover. So if you are operating a farm, that's your main source of revenue. In the year that you do have a farm loss, it's just treated as a regular business loss, included in 3D. Any of the farm losses you can't use up this year will just become non-capital loss carryovers. They follow the same rules: carry back 3 years, carry forward 20 years, and you can use it against any type of income. So that's sort of on the one extreme. On the other extreme, we have hobby farming. So what do we mean by hobby farming? You are basically having farming activities, but there's no expectation of profit. You're just sort of doing it as a hobby. You're not planning to make any money. So in the year that you have losses, those losses are denied. However, profits, income is taxable. So if you are operating a hobby farm and you do have net income in a particular year, you do have to report that, but any losses basically are denied. And what they look at is, are you operating the farm sort of as a business, or are you just sort of doing it as a hobby? So they look at sort of how much time you invest. Do you have a business plan? Is it something that you do invest a lot of time in? And that's sort of how they determine whether you're sort of operating the farm as a hobby or not. So that's sort of on the one extreme. If you're operating it as a hobby farm, losses are denied, but any sort of income is still going to be taxable. Any net income will still be taxable. On the other extreme, you're doing it full time. Any losses are just treated as a business loss. Any losses you can't use just become non-capital losses. And then we have sort of this situation in the middle, this part-time farming. So what do we mean by part-time farming? Unlike hobby farming, you do have an expectation of profit. So you are operating in hopes of making a profit. However, it's not the main source of your revenue. So it's different from hobby farming, because hobby farming, there's no expectation of profit. But with a part-time farming, you do have an expectation of profit. The difference between part-time farming and full-time farming is that with full-time farming, it is your main source of revenue. But for part-time farming, it's not your main source of revenue. So part-time farming could be a situation where maybe you have another full-time or part-time job. And farming is something you do, maybe half the time. So it could be sort of a seasonal farm where you operate at sort of just a couple months during the year. Or it could be a farm that you operate year round, but you don't spend all your time doing it because you have other work. Then you would sort of fit into this middle category called part-time farming. The unique thing about part-time farming is that if there is a farm loss in a particular year, part of the farm loss, a portion will be what we call unrestricted, and that will just be treated as a regular business loss. And then a portion will be considered restricted. Now, the restricted portion will become what we call a restricted farm loss. The restricted farm loss can only be used to offset farm income. And for restricted farm loss, you can basically carry them back 3 years and carry forward 20 years. But the main difference between the unrestricted portion just becomes a regular business loss. So that just becomes part of your non-capital loss. But the restricted portion is only able to be used to offset farm income, either carry back 3 years, carry forward 20 years. So how do we determine how much is restricted and how much is unrestricted? The unrestricted portion, I'll just sort of put the formula here. The unrestricted portion is equal to the first 2,500 and 1/2 plus 1/2 of the next 30,000 of losses. So that's sort of the way that the formula works. And let me just sort of show you how we can do that calculation by going through a simple example. Oops. So let's say we have this part-time farmer. And let's say in 2024, the part-time farmer has a $40,000 farming loss. And so we calculate the unrestricted portion, which will be the first 2,500 and 1/2 of the next 30,000. Now, this is sort of important because when we talk about 1/2 of the next 30,000, the first 2,500 has already been used. So the first 2,500 is already there. And when we say 1/2 of the next 30,000, that's going to be basically 32,500 minus 30,000. because maybe remember the first 2,500 is already used. So we're looking at the amount from, sorry, 32,500 minus 2,500. And so if we sort of work through that calculation there, that's going to be basically 2,500 plus 15,000. So the unrestricted portion is going to be 17,500. And that's just treated as a regular 3D business loss. And then the restricted portion will basically be the total 40,000 minus the unrestricted 17,500. And that leaves us with 22,500 as the restricted farm loss. And remember, the restricted farm loss you can only use against farming income, carry back 3 years, carry forward 20 years. I'll show you sort of another example just to sort of clarify what I mean by the unrestricted portion and how it sort of applies to the next 30,000 or the next one half of the next 30,000. So let's just look at another example. So separate example, in 2024, the part-time farmer has, let's say, a $10,000 farm loss. So the unrestricted portion will be the first 2,500 plus 1/2 of the next 30,000. Now we don't have enough for the next 30,000, so it's just going to be 1/2 of the remainder. So we already used the first 2,500. So if we work through this calculation here, it's just going to be 2,500 plus 1/2 of 7,500. Let's do that calculation quickly. So 1/2 of 7,500, that's going to be 3,750. And so the unrestricted portion will be 6,250. And then the restricted portion will be the full 10,000 minus the unrestricted. And so the restricted portion will be 3,750. So that's sort of how that formula works. When we talk about 1/2 of the next 30,000, if you don't have up to 30,000 in addition to the 2,500, then you just take your total farm loss minus the first 2,500 and then multiply that by 1/2. We'll go through some examples in the question that we do, but are there any questions about this restricted and unrestricted farm loss for a part-time farmer? So the question that we're going to work on first is going to sort of look at calculating net income, also calculating taxable income, and also looking at how we can sort of carry back losses. Carry forward losses is kind of easy. You just sort of apply them to your current year tax return. But we're also going to look at carrying back losses in this example as well. So the question that we're going to work on is assignment problem 11-1. And the taxpayer, Brenda, has given us 4 years of her financial information. So the information is for the 4 years that's given at the top. The paragraph below that talks about her farming activity. And we're told that her farm losses are restricted. So that means she's going to fall into that part-time farming category. And so anytime that she has farming losses, we calculate the restricted or unrestricted, and then the restricted portion. The dividend income has already been grossed up. And this is sort of important. Whenever we're looking at these questions here, always read the description carefully. We're given the taxable or grossed up dividend. So that means that we don't need to know whether they're eligible or non-eligible. They've already been grossed up by the appropriate amount. And then in terms of her capital gains and losses, the 50% has already been applied. We're given her taxable capital gain and her allowable capital loss. So the 50% has already been applied. If we were just given capital gain and capital loss, we would still have to multiply by 50%. So once again, read the questions carefully when you're going through these, because sometimes they give you the capital gain, capital loss amounts. Other times they do the 50% calculation for you already. There's also this talk about ABLES, allowable business investment loss. We're actually going to be doing that later today, so you'll have an understanding of what that is later on. When she has a choice, she would like to deduct the maximum net capital loss and then carry back any loss carryovers to the earliest year possible. None of her losses can be carried back before 2021. So 2021 is sort of the first year we're going to look at. And then it also talks about sort of how much income she needs every year. And this is sort of important. When it comes to individuals, you always want to leave enough taxable income to use up all your non-refundable tax credits. Now, in this paragraph, it says she needs $15,000 of taxable income, but that's only for the earlier years. It also talks in the required, it says, do not bring her taxable income below $15,705. The reason that that $15,705 is sort of relevant, if I bring up the rates table, is that is the basic personal amount for 2024. So let me just bring up the rates table. And if we look at the rates table here, the basic personal amount, $15,705. And so usually what taxpayers will do is they'll obviously figure out how much their non-refundable tax credits are. And then they want to make sure that if they can fully use all those non-refundable tax credits, because as we said in chapter 4, they're non-refundable. So if you don't have enough income to use them, then you don't get a refund, you can't carry them over. So in a situation where we can use some loss carryovers, we only want to sort of use enough to bring our taxable income to a point where we can still generate enough income tax to use these non-refundable tax credits. And so that's where that amount comes from. If we go back to the question, it basically says that in sort of any year, the amount of taxable income should be $15,000. But then it also talks about this $15,705. And that $15,705, even though it relates to the 2024 year, we'll just sort of use that as sort of the minimum amount of taxable income, just because that's sort of the number they give us, $15,705. We know that the basic personal amount does change year to year, but because it says do not reduce her taxable income below $15,705, we'll just sort of use that number for all the years in question. So let's start with 2021. 2021, she has business income, $18,000. So that's going to go into 3A. The farm loss, we have to figure out first how much is unrestricted and how much is restricted. The unrestricted amount will go into 3D. The dividends will go into 3A. And then the taxable capital gains over the allowable capital losses, those will go into 3B. So we're going to, excuse me, we're going to calculate net income first, and then we'll see if there's any further reductions to calculate taxable income. So let's go to 2021. Have it set up here. So 3A, we have the non-farming business income, the 18,000, the taxable dividends, 2,360. And then in 3B, we have the taxable capital gains over the allowable capital losses, 2,100. And then the only thing that we haven't looked at yet is the farm loss. So let's actually do that down here. So we know that the farm loss, let's do it up here. Let's do it up here instead. Well, so the farm loss totaled $10,000. So that was just the example that we just did. So that should be fairly easy. double check those amounts. Yeah, farm loss 10,000. So this is actually pretty easy. I didn't realize it was the same as the example I did earlier. So we have the unrestricted portion. That's going to be the first 2,500 and then 1/2 of the next 30,000. We don't have 30,000. So once again, this is going to be 6,250. And then the restricted portion is going to be 10,000 minus the 6,250. And so that's going to leave 3,750. So when we calculate our net income, the 3D amount will include the 6,250. So the unrestricted portion just becomes a regular 3D business loss. So if we sort of look at 3A, the subtotal for 3A will be 20,360. Remember 3B, we cannot have a negative amount. And so if we add up 3B, we'll see that we do have a negative amount. So 3B is going to be 0. Because we can't have a negative amount. This 1,500, that becomes a net capital loss carryover. And then if we go to our net income then would just be 3A plus 3B. 3B is 0. And then minus 3D. 3D is the unrestricted farm loss. And so that's going to give us net income of 14,110. Now, we don't have losses, but even if we did have losses, we wouldn't use them because remember we were told that they want to, she needs at least 15,705 in taxable income to sort of use up all her non-refundable tax credits. So in this situation, we don't have a choice. We can't not use this loss here as part of the calculation. So we don't have a choice. She's probably not going to be able to use up all her non-refundable tax credits, but that's just sort of the way it is. What we do have to do is keep track of these losses that carry over. Now, when you do file your tax return with the CRA and you report all this, they will keep track of your losses on their files anyway. But it's always sort of a good idea to sort of keep track of your own losses, just so that you know when they were originated from, what year. And then that way you can sort of figure out when they will expire. So the restricted farm loss, we'll just sort of put the year here. This originated in 2021. So we have restricted farm loss of 3,750. And then we also have a net capital loss that also originated in 2021 of 1,500. So those are the losses that were originating from 2021. And so we'll just sort of keep track of those here. Any questions about 2021? So let's move to 2022 then. So 2022, we have a business loss now. So this business loss will go into 3D. The farm income will go into 3A. The taxable dividends will also go into 3A. And then the taxable capital gains will go into 3B. So we have a huge business loss, 14,000. We have farm income, we have dividends, we have taxable capital gains. So let's go to 2022. And once again, we have to calculate our net income first. So 2022, in 3A, we have the farm income, 2,000. We have our taxable dividends, 2,950. Once again, it's given to us as the taxable amount, so we don't have to bother with doing the gross up because it's done for us already. And then in 3B, we have a taxable capital gain of 1,000. And then we have the business loss of 14,000. And so once again, we just sort of quickly do a quick subtotal here. 3A is going to be 4,950. 3B is 1,000. 3D is minus 14,000. Let's just sort of do a quick subtotal here. We probably have a negative amount. Remember we said if we have a negative amount, we can't create a negative net income. So this is sort of our subtotal. Because it's negative, that means our net income is going to be 0. And our taxable income will be 0 as well. This then becomes a non-capital loss carryover because we couldn't use up our complete business loss. So the unused portion becomes a non-capital loss carryover. So in our non-capital loss carryover column, let's put that here. I'll make a note that this originated from the 2022 year. So this originated from the 2022 year. I'll just bring that down here. And so we have a non-capital loss of 8,050. Now, once again, it's a good idea to sort of keep track of it on your own. Even though when you file your tax return, the CRA will have track of it as well. But just so that you know that this will expire in 20 years, so that way, if it does get to a point where it's about to expire, you're sort of aware of that. You try to use it before it expires. So that's why it's always a good idea to sort of keep track of these losses on your own as well. Any questions about 2022? Now, the one thing I want to just sort of bring up is something that was talked about in the textbook, and I don't know if I brought it over here. Let me see if I did or not. Don't think I cut it out. I'm just going to bring up the textbook quickly. Let me just bring up the e-textbook. And this is on page 658. So let me just bring up the e-textbook. And this is on page 658. And the one thing I want to just sort of look at is this title here, conversion of a net capital loss to a non-capital loss. Conversion of a net capital loss to a non-capital loss. Now you can sort of read this on your own, but basically what this says is that in a year where you could use a net capital loss to reduce your taxable capital gains, but you couldn't because you didn't have enough net income, it allows you to convert the amount that you could have used to a non-capital loss. Now, obviously, it's better to have a non-capital loss than a net capital loss, because a non-capital loss, you can use that against any type of income. Even though it expires in 20 years, it still would be beneficial to convert the amount that you could have used as a net capital loss into a non-capital loss. This is on page 658. So what does that mean in our situation? Let's go back to our Excel document. If we look at the year 2022, hold on a second. 2022, where are we here? Here we are, 2022, this year here. What we'll see is that we didn't have any net income. Because we didn't have any net income, we couldn't use any net capital loss. Now, we could have used up 1,000. If we had enough net income, we could have used 1,000 of the net capital loss. But because we had 0 net income, we couldn't do that. So what that means is we can convert that into a non-capital loss. So this net capital loss we have here, we could have used 1,000 of it this year if we had enough net income. But because we did not have enough net income, we can convert that amount to a non-capital loss. So what that means is that we would take off 1,000 here, and that would leave 500 in net capital losses, and we would convert that into a non-capital loss. And so our non-capital loss will now be 9,050. Once again, I'll just sort of make a page reference here. That was on page 658 of the textbook. Now, unfortunately, we can't do the same with the farm loss, because if you think about this as well, we had farm income this year. We had farm income of $2,000. And so if we did have enough net income, once again, we could have used some of this restricted farm loss up to 2,000 to reduce the farm income, but we couldn't. But unfortunately, there's no similar rule that allows us to convert farm loss into a non-capital loss. Only applies to net capital losses. So that's the conversion of the net capital loss into a non-capital loss. Any questions about that? So that's 2022. So let's go to 2023. So 2023 looks like a good year. There's quite a bit of income. So 3A would be the business income, 3A would be also the farm income, 3A would also be the taxable dividends, and then 3B would be the taxable capital gains. So let's look at 2023. Down here. So 3A, we have the business income, 30,000. We have the farm income, 3,150. So just make a note that this is the farm income. And then we have the taxable dividends, 3,963. The taxable capital gains, 2,000. And so our subtotal for 3A, 37,113. There's no losses this year, so we can go directly to our net income. So our net income 3A plus 3B is going to be 39,113. And remember, we want to try to bring the income down to 15,705 if we can. And so this is sort of where now we can use some of these loss carryovers. So to get from net income to taxable income, we can use some of these loss carryovers. Now, generally, it's always a good idea to use the one that are restricted in terms of the type of income you can use it against. So we do have farm income, and we also have taxable capital gains. So usually the best thing to do would be to use these types of loss carryovers first that are restricted in the types of income they can be used against. So the restricted farm loss, we have 3,750. So we can't use all of it up, but we can use up 3,150. And then for the net capital loss, we can use up the 500 because we have 2,000 in taxable capital gains. So let's use those amounts first. So we'll use the restricted farm loss. So we'll carry that forward and we'll use 3,150. And then we'll use the net capital loss. We'll carry that forward. We'll use the 500. And when you file your tax returns, there's a line to use up these losses. After you calculate net income for tax purposes, there's our lines there to use up the net capital loss, the restricted farm loss, and the non-capital loss. And then the non-capital loss, we can use all of it up as well, because remember, we still are above the 15,705. Let's just do a quick calculation and see to make sure that we're above this amount. So if we use up all these losses, what will be our taxable income? So it's going to be 26,413. That's still above the 15,705 that we need, but that's all we can do because we can't use up any more of the losses. The restricted farm loss, let's update it. So for 2023 tax year, we're going to use up 3,150. So the balance left going forward is going to be, oops, this should be 600. There's 600 left of the restricted farm loss. And then for the net capital loss, we're going to use up all 500. So there's going to be nothing left there. And then for the non-capital loss, 2023 year, we are also carrying that forward to 2023, using all of it up. And so once again, the balance going forward is going to be 0. So loss carry forwards are pretty easy. You just include them on the current year tax returns. And then once again, figure out how much taxable income you need to use up all your non-refundable tax credits. And then obviously don't reduce your taxable income below that if you have enough losses. Any questions about 2023? So then we move to 2024. And this year we have sort of quite a lot of losses again. We have a business loss, we have a farm loss, we have some taxable dividends, we have some taxable capital gains, but we have a lot more of allowable capital losses. So once again, let's just sort of plot these into our net income calculation and figure out what our net income is first. So for 2024, the only amount at 3A is going to be the taxable dividend, 6,450. In 3B, we do have taxable capital gains, 2,250, but our allowable capital losses are 7,250. So once again, the 3B amount is going to be negative by 5,000. So once again, we can have a negative 3B. So 3B will basically be 0. This 5,000 will be added to our net capital loss carryovers. And then we have losses in 3D. So in 3D, we have business loss, and we also have a farm loss. Now let's just sort of look at the farm loss. If we look at 2024, the farm loss was 2,000. So remember we said with the farm loss, the unrestricted portion is the first 2,500 plus 1/2 of the next 30,000. So for 2024 then, because our farm loss is only 2,000, it will all be unrestricted. All 2,000 will be unrestricted because it's the first 2,500. So all that can just be treated as a regular 3D business loss. So we know that the total in 3D then is going to be, oops, hold on a second. It's going to be 21,000. So we have 21,000 in 3D losses, and 3B is 0. 3A is 6,450. So once again, we just do sort of a quick subtotal here. We know that we're going to have a negative amount. And so that negative amount is 14,550. And that's going to become a non-capital loss. So our net income is going to be 0. Also, our taxable income will be 0. And we have these two lost carryovers that we can now update our schedule with. So we're going to have an additional 5,000 in net capital losses. So let's make a note here. So in 2024, we're going to have net capital loss of 5,000, and then a non-capital loss of 14,550. Now, once again, we don't have a choice. Our net income and taxable income are 0. So what that means is that all those non-refundable tax credits will basically be lost. We can't use them up this year. And so they are non-refundable. So that we basically lose them because we can't use them up this year. We'll talk about lost carrybacks now as well, but any questions about 2024 first? So remember, losses can be carried back 3 years. And if we just sort of look at the previous years, 2021 is fine because we're below that 15,705. So we don't want to carry any losses back to 2021. 2022, we have zero taxable income, so we obviously can't use any losses in 2022. But 2023, we still have quite a bit of taxable income. And this is sort of where we can carry losses back. So what we would have to do is file the 2024 T1 first. Once these losses are established on the CRA sort of data bank, once we file our 2024 tax return and all these losses have been updated to the CRA database, then we can file what's called a T1 adjustment. And I posted the T1 adjustment on eLearn, but I just want to show you what it looks like. So let me just bring up the document here. The T1 adjustment can be done electronically as well, but it can be also, I just sort of downloaded the paper copy of it. So this is it here. So this is the Canada Revenue Agency. And you'll see that the title here says T1 adjustment right at the top. And then all you do is just sort of fill in your social insurance number, all that stuff that's sort of up here. And then down here, you also have to put the year as well. So yeah, right up here, you put the tax year. So we would put 2023. And then down here, we would sort of put all the adjustment details. And so what you see is that you put sort of the line number that you want to change, and then you put in the previous amount. So if the previous amount was 0, you would just put 0, and then the amount of change in this middle column here, and then the revised amount. And then once again, you would sign it. You can file it electronically as well, and then just submit it to the CRA. And then they'll go through sort of a reassessment process. If they have any additional information that they need, they'll call you or email you. And then once they decide whether it's acceptable, they'll process a reassessment notice and then go through update the numbers that you provided. So that's what we mean by T1 adjustment. It's this form here. Now, corporations are done differently. Corporations, they can also make an adjustment to their tax return, their T2. But for corporations, they usually have to submit the request in writing. There's no sort of official form. They would sort of submit the request in writing as to what adjustments they want done, and then send that into the CRA. It gets assigned to an auditor, and then the auditor will look at it and then decide whether, once again, they need more information or can they just process the request automatically. But for T1s, this is what you use. Any questions about the T1 adjustment? So that's the form that you would need to fill out. So let me just bring us back to the question here. Chapter 11 handout. So what we want to do then is we want to file a T1 adjustment for 2023. So we want to file, actually, let's just sort of do this up here, right below 2023. So we're going to file a T1 adjustment for 2023. And so we have sort of the original taxable income. So the original taxable income was this $26,413. And remember, our target taxable income that's given in the question is $15,705. Now, once again, every taxpayer is different. Some taxpayers need more taxable income because they have more non-refundable tax credits. 15,705, like I said, that just sort of relates to the basic personal amount in 2024. But that's what the question says. Even though this is 2023, we'll just sort of use it because that's what they give us. So if we can, we want to reduce our taxable income to 15,705. And so we're going to file this T1 adjustment, basically saying we want to carry back some of these losses. Now, the first one we should consider, once again, we can't do anything about the restricted farm loss because remember in 2023, we already used as much of the restricted farm loss to offset the farm income. So the farm income that we did earn in 2023, that's been reduced to 0 by this restricted farm loss. So we can't use the restricted farm loss. But what about the net capital loss? We had 2,000 in taxable capital gains, and we used up 500 of the net capital loss. So that means there's still taxable capital gains of 1,500 that is still part of our taxable income. So we could use 1,500 of the net capital loss, carry it back from 2024 to 2023, and use it in this T1 adjustment to reduce our taxable income by 1,500. So the first thing that we're going to do is use up some of the net capital loss carry back. 1,500. And once again, that's going to offset the taxable capital gains that is still part of our taxable income. Any questions about that? So let's just quickly go to our schedule here. And these are amounts we're going to carry back to 2023. And so that's going to be 1,500. And so the balance going forward is going to be 3,500. And then we can still carry back this non-capital loss. Now, remember, we want only to use enough to get us to our target taxable income of 15,705. So let's just sort of see what so this would be our amended taxable income. So that's just going to be the sum of these three amounts here. So we know that we want to use up some of the net capital loss carried back from 2024. If we use up the full 14,550, that's going to bring us below our target. So we don't want to use up all of this. We don't want to use up all of the non-capital loss. So let's just sort of put 0 there. So basically this number here then is just going to be whatever we need to get us to our target. So basically right now we have 24,913 in taxable income. We want 15,705. So we sort of do that calculation. So 24,913 is what we have. We want to bring it down to 15,705. And so that means we're going to use up only 9,208 of the non-capital loss. And that's going to bring us to our target taxable income of 15,705. And so the amount we're going to carry back to 2023 is 9,208. And so the amount carry forward for use in future years is going to be 5,342. Any questions about the carrying back losses? So that's sort of what we refer to as sort of tax planning. We have all these losses. We have to look at how we can use them sort of the most effectively. And part of that is trying to figure out how much taxable income the taxpayer needs in any particular year to make sure that they can use up all their non-refundable tax credits. And so this is sort of is what we refer to as sort of the tax planning aspect of income tax. Any questions about this assignment problem? Just sort of a quick word about tax returns. I know that's right in sort of the season of filing tax returns right now. And I know that we have a tax clinic on campus. I don't know if any of you are involved in the tax clinic, but usually when you file your tax returns, at least over the last few years, is that everything, all your sort of T4 slips, your T5 slips, T3 slips, they're all sort of downloaded from the CRA website. But this year in particular, there's been sort of a huge delay in a lot of the tax slips being available on the CRA website. I think this has to do with, from what I read in the news, the CRA sort of had some IT issues, And so there's been sort of a delay in a lot of those T slips getting updated to the CRA website. And so if you are sort of filing tax returns, like for on your own or whether it be sort of in the tax clinic, just sort of be aware that when the data is transferred from the CRA website into sort of your own individual tax return, if you're using sort of tax software, always double check it to make sure all those slips are there, because if the CRA is experiencing delays in getting all the slips updated to their website, then all that information may not be current. So just sort of be aware, always sort of double check. It's always sort of a good idea to keep track of all your income from all the different sources and make sure that when you do sort of file your tax returns, if you are relying on the CRA to update all your tax slips, that you do double check to make sure that they're all there. Is anyone sort of involved in the tax clinic? I don't know, Justin, are you involved in the tax clinic on campus? Just sort of curious if anybody has experienced those issues. Justin?
No, I organized it all, but I wasn't filing.
Oh, okay, okay. Because I guess nobody else is involved in it. If anyone is, let me know. Don't see anybody unmuting. But just sort of be careful of that, because it is something that I even saw this year as well when I was using tax software to prepare my own tax return. I had downloaded, or I guess transfer all the information from the CRA website into the tax software I was using. And last year everything was there, but this year I would probably say like maybe a third of my T5 or T3 slips were not transferred from the CRA website. So it's always just sort of good to sort of double check on your own. And that's why it's good to just get the slips either emailed to you or mailed to you in paper form. And so that way you do have copies of your T slips, and that way you can double check when you're filing your own tax returns as well. What we're going to go on to next then is some sort of more advanced topics. Now, there's sort of a lot of information in Chapter 11, and we're just going to sort of touch on sort of the more important issues, just like we do with every chapter. We did go through Appendix B last week, so that was covered last week. The next thing I'm going to talk about is small business corporation shares. Special treatment for disposition of small business corporation shares. And then there's also sort of another type of corporation called a qualified small business corporation. So let me just talk a little bit about what each of these are first and why there's sort of this special treatment. So what is a small business corporation? Now, I think I copied it here. Yeah. So let's talk about what is a small business corporation first. So it's on this page in your textbook, and I copied it over here. So SBC, Small Business Corporation, it's a CCPC. And CCPC we've talked about before, and it's something that you'll learn more about if you take the advanced tax class, BFIN 451. As I mentioned last week, it's probably only going to be offered in the spring of next year. So like 1 year from now in the January term, January 2026. I don't think it's going to be offered in the fall. So, when you're planning your courses for next academic year, you probably won't see BFIN 451 in the fall term, but from what I gather, it should be offered in the spring term. And you'll learn more about corporations and what is a CCPC. But for our purposes, we're sort of just using the term CCPC. Government tries to give sort of certain benefits to Canadian-controlled private corporations. If you open up your own private corporation, it's not a public corporation here in Canada, then your corporation could get sort of certain tax benefits. So a small business corporation, an SBC, has to be a CCPC, and all or substantially all of the assets are used in an active business, primarily in Canada. So what is all or substantially all? All or substantially all means at least 90%. So at least 90% of the fair market value of the CCPC's assets are used in an active business carried on primarily in Canada. Primarily means more than 50%. So what this means is that you have this private corporation that's controlled by a Canadian person, and the majority of the assets, over 90%, are used in an active business. So active businesses means basically, not passive in nature. So when we talk about active business, we sort of mean not passive in nature. And so what we mean by that is you're sort of generating business income, not sort of passive income, like interest and dividend income. So once again, we're not sort of going to get into sort of like having to identify what is a small business corporation. You'll sort of be given that in the question, but that's sort of the definition of a small business corporation. It's a Canadian-controlled private corporation, greater than 90% of the fair market value of the assets used in an active business, that primarily more than 50% in Canada. So it's just saying that if you meet this definition of an SBC, and you sell shares in an SBC, you might get special treatment. And then we have this definition called qualified SBC. So what is a qualified SBC? So qualified SBC is down here. QSBC, qualified SBC. So a QSBC must also be an SBC. So it must meet all this definition up above of what an SBC is. In addition to that, there's two additional rules. So it must meet the definition of SBC, but then there's two additional rules. There's a 24-month holding period test. The shares must not have been owned by anyone else for the last 24 months. So you, or maybe your spouse, must have held those shares for the last 24 months continuously. That's the 24-month sort of holding test. And then there's sort of this 24-month asset test. Over the last 24 months before the shares were sold, more than 50% of the assets, again, used in an active business, primarily in Canada. So this is important. For an SBC, a small business corporation, this 90% fair market value assets only has to be met at the time the shares are sold. So when the shares are sold, if at least 90% of the assets used in an active business carried on primarily in Canada, then the SBC definition is met. So SBC sort of measures at a point when the shares are sold. But QSBC looks at the SBC as well. So looks at when the shares were sold. It has to meet the SBC definition. But in addition to that, it looks at the last 24 months to make sure that these two additional rules are met as well. You must have owned the shares for the last 24 months before they were sold. And then the CCPC must have used more than 50% of the assets in an active business carried on primarily in Canada for the last 24 months as well. So once again, don't worry so much about the fine details of the definitions. You can easily look them up in the textbook if you need to. But in the questions, we'll sort of be told whether they're a QSBC, SBC, and so forth. So why do these definitions matter? Well, once again, there's certain benefits when you sell shares in an SBC and QSBC. So what are those benefits? If you sell shares in an SBC at a loss, normally it would be a capital loss. Let me just sort of make some notes here. So let's sort of make some notes here. So normally when shares are sold at a loss, the loss is capital loss times 50%, and that's your allowable capital loss. And the allowable capital loss can only be used to offset taxable capital gains. Any sort of unused amounts become net capital loss carryovers. And remember, we said net capital loss carryovers, you can only use those against taxable capital gains. So this is different. When you sell shares of an SBC, and this could apply to debt as well, what we mean by that is that, let's say you loan money to an SBC. I realize that I have this backwards. I have it as SCB. This should be SBC. Change that. So when you sell shares in an SBC, or you dispose of debt, so if you loan money to a small business corporation, and let's say the business goes bankrupt, so you don't get your loan paid back, then you would have basically lost money as well. So it relates to losing money when you sell shares. It relates to losing money if you loan money to an SBC and you don't get paid all the amount back. Normally, that loss would be a capital loss. But if it relates to an SBC, then the loss becomes a business investment loss, a BIL. You still multiply it by 50%, and that 50% becomes an allowable business investment loss or an ABLE. And the benefit of that is that, let me just sort of make some notes here. If you have a business investment loss, let's say you have this $10,000. I'll just put a bracket here. So let's say you sell shares in an SBC and you have a $10,000 loss. That then becomes a business investment loss times 50%. And so your ABLE is going to be 5,000. And the benefit of that is then the ABLE of 5,000 becomes a regular 3D loss. So that's better than it be treated as an allowable capital loss, because allowable capital losses you can only use against taxable capital gains. But when you sell shares or you sell debt in an SBC at a loss, the loss amount, the 100% amount, is known as your business investment loss. 50% of that is known as your ABLE, your allowable business investment loss, and that just becomes a regular 3D loss. But what if the amount is unused? Let's say the ABLE cannot be fully used in the year. Then the unused amount will become non-capital loss carryover. But there's sort of time restriction. It will only remain as a non-capital loss carryover for the next 10 years. After 10 years, any unused amount reverts to a net capital loss. Because remember, this originated from the sale of shares, right? So it wasn't net capital, it was like an allowable capital loss from the beginning, but because it was from the sale of shares in an SBC, it got special treatment. The 50% amount just becomes an ABLE, a regular 3D loss in that year. Anything that you can't use in that year just becomes a non-capital loss because it originates from 3D, but it only remains as a non-capital loss for the next 10 years. You can still carry it back 3 years, but you can only carry it forward for 10 years. And if there still is any amount remaining after 10 years, then that amount reverts back to a net capital loss. So after 10 years, any unused amount will revert back to a net capital loss. Any questions about that? So you sell shares in an SBC or you dispose of debt because you can't get paid back. That becomes a business investment loss. 50% as you're able becomes a regular 3D loss in the year. Anything that you can't use up becomes a non-capital loss. And then if you can't use that up in 10 years, it reverts back to a net capital loss. So that's if you sell shares in an SBC at a loss. What about the QSBC? So remember we talked about qualified small business corporation that still have to be an SBC, but then they had those 2 additional rules for the 24 months prior. So if you sell shares in a QSBC and you sell them at a gain, that capital gain is 50% taxable, but that 50% taxable capital gain could be reduced or eliminated by the lifetime capital gains deduction. And for 2024, the lifetime capital gains deduction is $1,016,836. Now that's the 100% amount. So we are still to multiply this by 50% to get how much it can be used to offset taxable capital gains. And that's going to be 508,418. So the 1,016,836, that's the 100% amount that will be used to offset capital gains. But remember in 3B, we only include the taxable capital gains. So we have to multiply this by 50% to get the amount that can be used to offset the taxable capital gain amount. If you qualify to use the lifetime capital gains deduction, the lifetime capital gains deduction is a deduction when calculating taxable income. So this is one of those deductions that come up when you calculate taxable income. Now, let me just sort of show you where this is on the rates table. So I'm just going to quickly bring up the rates table here. So here's our rates table. We scroll down to page 2, page 3, page 4, page 5, top of page 6. So top of page 6, capital gains deduction right up here. There's that amount, 1,016,836 offsets taxable capital gains of 508,418. Now this amount changes every year, is indexed to inflation. So last year it was lower, next year will be higher. But once again, this is sort of a lifetime amount. And once again, you can only sort of use it if you sell shares in a QSBC. Now, it also applies to selling qualified farm and fish property. We're not going to sort of look at that in this course. We're just going to focus on the QSBC shares that are sold at a gain. But if you sold some farm or fish property at a gain, you could also use this lifetime capital gains deduction amount as well. And once again, this is a deduction when you calculate taxable income. Now, it's a fairly complex topic, the capital gains deduction. So we're just going to sort of look at it sort of at a very high level and in this course here. But it is, if you do go and read through the textbook, it is sort of a very complex topic. And for purposes of CPA, if you're going to enter the CPA program, these sort of more complex topics, all you need is just sort of a basic understanding. You don't really need to know the full details and all the rules, just sort of a basic understanding. One of the sort of the wrinkles of the lifetime capital gains deductions and ABLE is that the 2 rules do interact. So let me just sort of make some notes here. The rules, sort of ABLE and the capital gains deduction rules do interact. The way that they interact is that any amount used of the capital gains deduction, so any amount, let me just word this properly, any amount of the capital gains deduction used up in current or previous years will limit the amount that qualifies as an ABLE or business investment loss / ABLE. We'll sort of explore that in a simple example and then go through a textbook problem, but actually let's do the simple example first, and then we'll take a break and then we'll do sort of a more complex example. So let's just sort of look at this simple example here. I changed the dates here. So in your handout, I had sort of last year's dates. So if you want to just sort of update those on your handout as well. So let's just sort of look at this simple example. Let's say it's the 2024 year, and we sold some shares in a QSBC, Qualified Small Business Corporation. The proceeds were $250,000, and the adjusted cost base was $245,000. And this year, the lifetime capital gains deduction is that $1,016,836. So we know that this sale needs to be reported in 3B, but we also have some net employment income. So we also have some net employment income of $50,000, and we also have the sale of these QSBC shares. So what's going to be our 3B amount? So our 3B amount, we have $250,000 minus $245,000. So our capital gain is going to be $5,000 times 50%. And so we have $2,500 taxable capital gain. So 3A is going to be, so let me just make some more room here. So 3A will be 50,000, 3B will be 2,500. So our net income for tax purposes is going to be 52,500. Now this is where we use the capital gains deduction. Some textbooks call it the lifetime capital gains deduction. I think this textbook used to call it the lifetime capital gains deduction, but then they changed it just to the capital gains deduction. So let me just use their abbreviation, capital gains deduction. So let's say that this taxpayer has never used any of the capital gains deduction, so they still have this full amount available. And the amount that they're going to use, so once again, this is based on the 100% amount. So they're going to use up 5,000. They're going to use up 5,000 because once again, they need 5,000 to offset 2,500 of the taxable capital gain. So this would be the amount that they will use up in 2024. And so the balance that they will have remaining is going to be $1,011,836. So that's how much they have sort of left over that they can use in future years. So this amount gets reduced every time you use it up. On the actual tax return, their capital gains deduction here, that's going to be the 5,000 times 50%. And so just move this over here. And so that's going to be a reduction of 2,500. So the taxable income is going to be $50,000. So once again, the amount that you use, this one here, there's actually a calculation that you have to use. So let me just sort of make some notes here. The amount of the capital gains deduction used is actually the lesser of 3 amounts. And that's sort of what I meant earlier when these rules are very complex. So we're not going to get into sort of that calculation. But if you look at the textbook, you'll see that is actually the lesser of 3 amounts. But for our sort of introductory tax course, we'll use just sort of the amount based on the taxable capital gain that we have. And so our taxable income is only going to be $50,000. Let's move on to next year. Next year, then, we sell shares in an SBC. Proceeds of 100, adjusted cost base of 20. So now we have a loss. And let's say we have no other income this year. So our 3A amount will be 0. We don't have any other income. In 3B, we have the sale, we have the proceeds minus the adjusted cost base. Oops. And so the proceeds are 100,000. The adjusted cost base is 120. And so that's going to give us a loss of 20,000. Now, remember we said because this is an SBC, normally this would be a capital loss. But because this is an SBC, then we can treat this as a business investment loss. But remember I talked about how the two rules interact. Remember I said here, if we use up any of the capital gains deduction, that's going to limit the amount that will qualify as a business investment loss. So we got to figure out how much of the capital gains deduction have we used up. So we've used up 5,000. That's the 100% amount. And so that's going to limit the amount of this 20,000 that will qualify as a business investment loss. So what will happen then is 5,000. So we've used up 5,000 of the capital gains deduction. That's the 100% amount, right? Remember the taxable capital gain was 2,500, but the capital gain was 5,000. So we're still talking about the 100% amount. So what that means is that of this 20,000, 5,000 will remain as a capital loss. And then the remaining 15,000 will be a business investment loss. So that's sort of how the two sections or rules, set of rules interact. You can't have the best of both worlds. That's basically what the government is saying, is that if you've used up some of the capital gains deduction to basically reduce or eliminate the capital gains on the sale of QSBC shares, then that's going to reduce the amount that will qualify as a business investment loss. You can't have the best of both worlds when you're looking at these two sets of rules. But because we've only used up 5,000, 5,000 will remain as a capital loss. Once again, we have to multiply this by 50%. Let me just make some more room here. So in our allowable capital loss then will be 2,500. And then for the business investment loss, we've got to also multiply that by 50%. And so our able will be 7,500. So it's still the 20,000 times 50% is 10,000, but some of that's going to be a 3B allowable capital loss, and the remaining amount will be a 3D able allowable business investment loss. So 3B then will still equal 0, because remember in 3B we can't have a negative amount. What will happen then is this amount will go to 3D. So in 3D, we'll have this able amount of 7,500. But if you think about this overall, the net income for tax purposes will be 0 because we have no income in 3A. 3B is 0. 3D, we do have a negative amount, but we can't have a negative net income. So what that means is that the 3B loss that we can't use up, that's going to become a net capital loss carryover. So the 2,500 from 3B that we can't use up, that's going to be a net capital loss carryover. We can't use up any of the 3D amount. And so that's going to become a non-capital loss carryover. And once again, the rule is this can be carried back 3 years, but it can only be carried forward 10 years. After 10 years, any unused amount will revert to a net capital loss. the net capital loss amount, the 2,500. Once again, that can be carried back 3 years. Carry forward indefinitely, but only used to offset taxable capital gains. So that's just sort of a simple example, just sort of illustrating how the rules between the ABLES and the capital gains deduction interact with one another. Any questions about this simple example? So it's after 7:21. Why don't we take a break? We just have this one question left to do, so we don't have we're definitely on good timing. So why don't we take a break and come back at 7:30? So I'll see you back here in just under 9 minutes. So what we're going to do now is go through assignment problem 11-2. And so we scroll over here. Let's just sort of work through the question together. We have this individual, Lucinda, and she won a lottery several years ago. She won the lottery in 2021, and then she started investing the money that she won from this lottery. And we have the investment income over the last 3 years, 2022, 2023, 2024. So let's look at 2022. So in 2022, she realized a large capital gain on the sale of some shares in a small business corporation. The shares were eligible for the capital gains deduction, as these were QSBC shares. So remember I said you'll sort of be told that in the question. And the capital gains deduction, that's the $1 million amount. And she used up 156,000 of the capital gains deduction. So once again, the capital gain was 156, and so 50% of that was 78,000, and that's how much was used to reduce her taxable income. And then we move to 20. So let's just sort of make a note of that. So I made a note of that in 2022 here. She used up this amount of the capital gains deduction. That's the 100% amount, not the 50% amount. The 50% amount was the 78,000 that was talked about in the question. So used up like capital gains deduction of 156,000 to offset taxable capital gain of 78,000. So just always sort of be aware of what is the 100% amount and what is the 50% amount. So that was 2022. Then we move to 2023. And we're given some income amounts, taxable capital gains, rental income, and interest income. So what does the question want us to do? So let's look at the required here. It says calculate her taxable income for 2023 and 2024. And consider the effects of the basic personal amount, indicate any lost carryover balances available, and then also talk about claiming the lost carryovers. And so this is sort of similar to the question that we did at the beginning of today's class, where we want to just sort of make sure that we, if we can, leave enough taxable income for her to use her non-refundable tax credits. And in this paragraph before the required, it says the only tax credit available to Lucinda is the basic personal amount. Now, the basic personal amount in 2023 was 15,000, and in 2024 was 15,705. So this is a little bit different from what we did in the last question. The question we did at the beginning of the term, the class, they just told us to don't bring the taxable income below 15,705. But in this question, they're saying that for 2023, we can have taxable income of 15,000, and for 2024, we can have taxable income of 15,705. And that would be all the taxable income we need to use our non-refundable tax credits, because the only non-refundable tax credit we have is the basic personal amount. So let's look at 2023 then. We have taxable capital gains. Remember, taxable capital gains means that 50% has been applied. If we were given capital gains, then we would have to multiply that by 50%, but we're given taxable capital gain. She also has rental income and interest income. So let's go to 2023. Her rental income and dividend amounts, was it dividend? Yeah, rental, so rental and interest. Rental and interest, 91,450 and 38,275. And then in 3B, taxable capital gains, 17,300. Now, we don't have any 3C and 3D amounts, so 3C and 3D. Just going to assume those are 0. So net income would just be 3A plus 3B, 147,025. And once again, there's no indication that there's any loss carryovers that were available from previous years. So both her net income and taxable income will be $147,025. That's 2023. And then we move to 2024. So in 2024, she also has taxable capital gains and rental income and interest income. So let's just set those up first. Taxable capital gains, 18,620. Rental income, 86,300. Interest income, 27,438. So let's just put those down for 2024 first of all. And the taxable capital gains, 18,620. And then we're given some information about this company that she loaned money to. So she had loaned $675,000 to this small business corporation called Recovery Inc. So she probably loaned the money, a few years ago after she won the lottery. She started investing in all these companies. So one of the investments she made was she made a loan to Recovery Inc., which is an SBC, Small Business Corporation. And in 2024, Recovery Inc. began bankruptcy proceedings. And the bankruptcy trustee basically told her that it's extremely unlikely that she's going to recover any of this amount. So remember we talked about sort of the disposition of shares in an SBC or the disposition of debt of an SBC. Well, this isn't a disposition of debt. And what taxpayers can do is if they loan money and they can't recover all or part of the loan, they can make an election that they basically sold this debt, this loan receivable, for proceeds equal to 0. So it's unlikely she's going to collect any of the $675,000. So she can treat it as basically a disposition of this note receivable, this loan receivable, for 0 proceeds. And so what that means is that she sold it for 0 proceeds. The cost is $675,000. So now she has this capital loss of $675,000. And that's sort of what I have indicated here. She basically filed this election to dispose of the debt for 0 proceeds. The loan had a value of $675,000. And so now she has this capital loss of $675,000. And once again, this is from Recovery Inc. Is a small business corporation. or SBC for short. So what that means is that this capital loss may qualify as a business investment loss or a BIL. But remember we talked about how the QSBC rules and the SBC sort of rules interact. So remember how she used up 156,000 of the capital gains deduction. So what that means is of this capital loss, the amount that will remain as a capital loss will be up to the amount of the capital gains deduction that was used up. So the amount that will remain as a capital loss will be basically equal to the capital gains deduction used up. And so that's going to be a capital loss of 156,000. And so then the remainder will be minus 675. We're going to keep 156 as a capital loss. So the remainder of 519, that's going to be the business investment loss. Now these amounts still have to be multiplied by 50%. Oops. So we still have to multiply these amounts by 50%. Oops. So the allowable capital loss will be 78,000, and then the ABLE, the allowable business investment loss, will be 259,500. So what will happen then is the allowable capital loss will go now to 3B. So this allowable capital loss of 78,000 will go to 3B, and the ABLE, this amount here, will go to 3D. That is going to just be treated as a regular 3D business loss. And any questions so far? So then let's just do some subtotals. Our 3A amount, 113,738. Oops. So 3B cannot be negative. We have negative 59,380. So we know that 3B will equal to 0. This amount will become a net capital loss. So this amount of 59,380, that's going to be part of our net capital loss carryover. So let's just sort of make a note of that. We're going to have a net capital loss carryover of 59,380. That originates from the 3B amount. And then what about our net income for tax purposes? We have 3A, 113,738. 3B is 0. 3D is negative 259,500. So we know that we can't have a negative amount for net income. So let's just figure out how much of that 3D loss we can't use up. So we cannot use up 145,762 of the 3D loss. We know that net income will be 0. Taxable income will also be 0. This amount of the loss we can't use up, that's going to be a non-capital loss. So we're going to also have a non-capital loss carryover equal to 145,762. Now, just sort of some rules here again. Just this here. The net capital loss, once again, carry back 3 years. Carry forward indefinitely. used to offset taxable capital gains only. The non-capital loss, once again, this originates from an able, so this can be carried back 3 years, but it can only be carried forward 10 years. And then it can be used to offset any income. And then after, or any unused amount after 10 years will revert to a net capital loss. So because this non-capital loss resulted from an able, it would only carry forward for 10 years. It can be used against any type of income. And then after 10 years, anything that's unused will revert to a net capital loss. So once again, this is different from regular non-capital losses. Regular non-capital losses, you can carry back 3 years and carry forward 20. And once again, offset any income. So this one is different because it originates from an able. We're going to look at carrying losses back, but any questions to the end of 2024? So for 2024, this taxpayer has no income. So once again, those non-refundable tax credits, they're going to lose them because they have no income to generate any income tax payable. But what they can do is carry losses back. So remember we said in the question, the only tax credits that this individual has are the basic personal amount. And for 2023, it was $15,000. And so remember the basic personal amount, we multiply by 15%. And so if we just quickly look at our rates table quickly. So the rates table that I'm going to bring up is for 2024. And so that's why the basic personal amount that you see here, 15,705, is higher because it's for 2024. But they give us the 2023 amount in the question. And if you remember, the first 50 some odd thousand of taxes federally will only be taxed at 15% right up here. So that's why we want to sort of leave enough income so that the income that we leave on the tax return multiplied by 15% will be offset by the basic personal amount, which we also have to multiply by 15%. So that's why for 2023, if the basic personal amount is 15,000, we want to leave 15,000 of taxable income to utilize the basic personal amount non-refundable tax credit. So that's sort of where that's coming from. So if we go back to our spreadsheet, what we can do then is take a look at 2023. So in 2023, this is our net income and taxable income right here. And so what we're going to do again, just similar to what we talked about before, is that we are now going to file what's called a T1 adjustment for 2023. And once again, we do that after we file the 2024 return. The 2024 return has to be filed first in order to establish these losses. Once those losses are established on the CRA database, then we can file the T1 adjustment. So in this example, let's figure out how much of the net and non-capital loss we can use up. So the net capital loss, generally taxpayers want to use that up first because it can only be used against taxable capital gains. So let's see, how much do we have in taxable capital gains for 2023? 17,300. So what we want to do then is use up the net capital loss first. So we're going to carry it back from 2024. And we're going to use up 17,300 of the net capital loss. And so what we can do then is let's just sort of update our net capital loss. So we're going to use up 17,300. So that's going to leave, what is that? 59,380 minus 17,300. It's going to leave us with $42,080 in our net capital loss. Now, the non-capital loss, we can use that against any type of income. And so we have 145,762. So let's go look at our T1 adjustment. And so our amended taxable income, what we want is 15,000. That's sort of our target. So let's just sort of see where we're at now. So we do just sort of a quick subtotal. We take the 147.25 minus the net capital loss. We have 164,325. If we want 15,000 in taxable income, the sort of the missing amount, this amount here, we'll just sort of do a quick calculation, this amount here would just be this minus the 15,000. And so the amount of the non-capital loss, well, that can't be right. Oh no, I had it. Sorry, this is wrong. This should be, should be minus the 17,300. Hold on a second. There. Yeah, so this subtotal was wrong here. So the 129,725, that's the subtotal from taking the original taxable income minus the net capital loss. And because we want to bring our income down to 15,000, the amount of the non-capital loss that we will need to use is 114,725. So if we put that down here, 114,725, and we just sort of, let's just sort of add up this total column here. That's going to give us the 15,000 that we need. And so once again, this target taxable income, that's going to be different for every taxpayer. You know, some taxpayers that have a lot of non-refundable tax credits, their minimum taxable income that they want to sort of leave on their tax return might be considerably higher than just the BPA amount. So that's going to be different for every taxpayer. So the last thing that we want to do then is just update the amount of the non-capital loss we have left. So the non-capital loss, we're going to use up 114,725. What does that leave us? 145,762 minus 114,725. So we're going to be left with $31,037 in the non-capital loss carryover. And once again, that's going to carry forward for 10 years. And then if we have any amount of that still unused, then we'll revert to a net capital loss. And once again, that's a special rule as it relates to ABLEs. Normally, non-capital losses will carry forward for 20 years. Any questions about this assignment problem? So what I want to do is just sort of wrap up and just sort of bring us to eLearn. That's, let's see, there's a question. So instead of using the T1 adjustment, could you decide to not use 15,000 of it? Trying to understand your question here. Instead of using the T1 adjustment, could you decide not to use 15,000 of?
If it's easier, so just basically when you're going through it and you get to the end of yeah, the ABLE, like the ABIL line, could you just like leave 15,000 on
Are
that?
you talking about this amount here that we're using up?
No, like further back there. So like when you got 3A, 3B, could you elect to use like 130,000 instead? So then you're just left over with about 15,000. Would that be like another way to do that?
You're talking
Or
about this amount here?
no, if just to your left. Yeah. Yeah, right there. Because yeah, you have the able with the 145.
Oh, I see what you're saying. So so when we're calculating net income for tax purposes, so what you're sort of talking about here is that you want to leave 15,000 here, right? That's what
Yeah.
you're saying. We can't do that. So when it comes
Okay.
to calculating net income, we have to follow these rules here. So we have no choice but to have zero net income. We can't reduce this by a smaller amount. Yeah. Does that answer your question?
Yeah, that makes
Yeah,
sense.
yeah. So that's something that's really important. It's good that you asked that. When we're calculating net income, we have to follow the rules of 3A plus 3B minus 3C minus 3D. We have no choice. When it comes to using the loss carryovers to calculate taxable income, that's when we do have some leeway, whether we use the losses or not. But to calculate net income, we have to follow the rules. So this net income will be zero. We can't not use some of the 3D amount. We have to use as much as we can for the current year losses. We don't have any choice there, but yeah, that's a good question. Any other questions about this assignment problem? So let me bring us to eLearn. I just want to sort of leave some time to answer any questions about the final exam. I think that's all for chapter 11. Yeah, that was all for chapter 11. So let me just bring up eLearn here. So the chapter 11 homework is going to be due on Sunday. So make sure you get it done on Sunday. Final exam again, a week today, 6:30 to 9:30. I will be available on Zoom before the final exam. And once again, if you have any questions while you're studying for the final exam, feel free to reach out to me by email as well. But if you do have any last minute questions, we can jump on Zoom sometime between 6 and 6:30 if you have any questions. So keep that in mind if there's sort of any last minute questions that you have. Just maybe just drop me a quick email. Just say, can we meet on Zoom before 6:30? And we can easily do that. The final exam again will only move forward. So just like the two midterms, it will only move forward. There will be 14 multiple choice, 6 problems. And once again, for the problems, make sure that you show all your supporting calculations. And once again, budget your time properly. The final exam will cover chapters 8, 9, 10, and 11. But some of those chapters do require knowledge from earlier chapters. So remember in chapter 8, there was some disposition of depreciable assets. So you have to know how to figure out recapture, so forth, terminal losses. Calculating net income for tax purposes, that was sort of chapter 11. So some of that knowledge that we learned in earlier chapters do carry over to these chapters as well. Chapter 10, we talked about RRSPs, and we talked about how when you're calculating your earned income for RRSPs, that you don't deduct the RPP deduction as you normally would when you're calculating net employment income, as we learned in chapter 3. So there are sort of certain concepts that do carry over to chapters 8, 9, 10, and 11. So just sort of be aware of that. And obviously the best thing to do is just work through the self-study problems and the exercises, and that will be sort of the best way to prepare for the final exam. You don't need to be on Zoom for the final exam, but once again, make sure you're logged into your CapU email. You will be given sort of the 3 hours, 6:30 to 9:30. So make sure that you do start on time, because if you do start late, unfortunately, because the exam is on eLearn, I'm not able to sort of extend the time if you do start late. So make sure that you do start on time at 6:30. Any questions about the final exam or anything about the course overall?
So is it similar format in the sense like we can access the textbook and stuff like that if we have like a weird specific thing to find?
Yeah, I mean, it is sort of open book, but with these online exams, it is sort of open book just because there's really no way to monitor it. So it is open book, just like with the 2 midterms. But obviously, don't rely on that because it is move forward only. So you need to sort of still study and make sure you sort of know where everything is so that you do, finish the exam on time. For the first midterm, especially the last midterm, there were some students that didn't finish. And so once again, don't rely on the fact that because it's an online exam that it is open book. Make sure that you still do study because if you don't finish the exam and with midterm number 2, I think the last question was worth about 5 marks. Some students didn't even get to the last question on midterm number 2. So you can't spend 20 minutes just for one multiple choice looking for the answer in your textbook, but it will be open book. It's just because it is an online exam. Any other questions that I can answer? Let me just check the chat quickly. Don't see anything in the chat. So that is it. Make sure you get the chapter 11 homework done. And when you are studying, feel free to reach out by email. I can try to help you by email. If we can't answer your question by email, we can always set up a Zoom session. And once again, it will be available on Zoom before the final exam. So 6 o'clock onward next Wednesday. Feel free to just email me if you want to jump on Zoom and ask any last minute questions.